Every financial crash feels like a failure. Banks collapse, markets implode, people lose homes, savings, jobs. Politicians panic, news anchors talk about chaos. But here's the part no one stops to question. Why do central banks come out of every crash bigger, stronger, and more powerful than before? If they're supposed to prevent crises, why do their powers expand after each one? And why does every temporary emergency measure somehow become permanent? This isn't about secret meetings in dark rooms. It's about something more subtle and more powerful. It's about how crises reshape authority. Tonight, we're tracing the pattern. Part 1. Origins. Born from panic, central banks weren't created during calm times. They were born in fear. Take the creation of the Federal Reserve in 1913. It followed decades of banking panics, especially the Panic of 1907. Banks were failing. Liquidity vanished overnight. The financial system froze. The argument was simple. Private banks couldn't manage systemic risk. There needed to be a lender of last resort. So the Fed was born with limited powers: provide emergency liquidity, stabilize the banking system, smooth out volatility that SIT. But here's the pattern. Every time the system broke again, the solution wasn't to reduce central authority, it was to increase it. Part 2. Rise crisis as a gateway to expansion. The first massive expansion came during the Great Depression. When the stock market crashed in 1929 and banks failed across the country, the financial system didn't just need liquidity, it needed restructuring. The Fed's role grew. The government severed the dollar's link to gold domestically in 1933. Later, in 1971, under President Nixon, the U.S. ended the gold convertibility entirely, closing the Bretton Woods window. Money was no longer constrained by metal. It was constrained only by policy. That moment quietly transformed central banking. Gold backing meant more flexibility. More flexibility meant more discretion. More discretion meant more power. But the real turning point wasn't the Great Depression. It was 2008. Part 3. Breaking point. The 2008 financial crisis, when Lehman Brothers collapsed. The system froze again. Credit markets seized. Major institutions teetered on the edge. The entire global financial structure looked fragile. This time, central banks didn't just cut interest rates. They invented something new. Quantitative easing, QE. The Federal Reserve began buying massive amounts of government bonds and mortgage-backed securities. It expanded its balance sheet from under $1 trillion to over $4 trillion in a few years. The justification: emergency stabilization. Look at the cause and effect chain. Banks took excessive risk. Markets crashed. Central banks injected liquidity. Asset prices recovered. Central banks retained new tools. QE was supposed to be temporary. It never truly ended. The same thing happened in Europe with the European Central Bank. The same logic appeared at the Bank of Japan. Balance sheets ballooned globally. Here's the twist. Crises didn't reduce central bank influence over markets. They embedded them deeper into markets. They became the largest buyers of government debt, the largest influence on interest rates, the silent backstop of asset prices. Markets no longer just reacted to economic data. They reacted to central bank statements. Power shifted quietly. Part 4. Fallout. When emergency becomes normal now. Fast forward to 2020. A global pandemic hits. Markets crash again. Within weeks, central banks deploy tools even more aggressive than 2008. Unlimited QE corporate bond purchases, direct support for credit markets. Near zero or negative interest rates, the Fed's balance sheet surged past $7 trillion and $8 trillion. This wasn't just liquidity support anymore. It was structural market intervention. Here, as the repeating pattern. Crash emergency authority. Expanded mandate, market dependence, permanent power shift. Each crisis normalizes previously unthinkable actions. In 2007, direct corporate bond buying was radical. By 2020, it was routine. And once markets adapt to that support, removing it becomes dangerous. Asset prices depend on it. Governments depend on low rates to finance deficits. Investors depend on central bank signals. Dependency creates leverage. Part 5. Failed fixes the illusion of reform. After every crash, there are promises of reform. After 2008, tighter regulation. After 2020, more resilience. But notice what rarely changes: the structure of debt expansion. Global debt has climbed from roughly $87 trillion in 2002 over $300 trillion in recent years. Governments borrow more, corporations borrow more, consumers borrow more. Low interest rates make debt manageable until inflation surges. When inflation spiked in 2021 to 2023, central banks raised rates aggressively. The result: bank failures returned. Volatility surged. Debt servicing costs exploded. The system revealed its dependency on cheap money. And who controlled the lever? The same institutions that expanded during the last crisis. Every fix seems to increase systemic reliance on central authority. Part 6. Modern parallels: the pattern repeats. Let's look at the pattern clearly. Step 1. Excess risk builds during easy money. Step 2. Asset bubbles inflate. Step 3. Crash exposes fragility. Step 4. Central banks intervene massively. Step 5. Their balance sheets expand. Step 6. Markets become structurally dependent. It's happened across decades. It's happened across continents. It's not about conspiracy. It's about incentives. Politicians avoid immediate pain. Markets demand stability. Central banks step in. Short-term stabilization leads to long-term centralization. Even digital currencies now enter the conversation. Central bank digital currencies, CBDCs, promise efficiency, but they also extend monetary reach directly to individuals. Again, crisis justification gives structural expansion. The mystery from the beginning starts to answer itself. Crashes are not engineered for power, but they are opportunities to consolidate it. And history shows those opportunities are rarely reversed. 3 clear takeaways. 1. Crisis expands authority faster than prosperity ever could. Emergency measures feel justified in panic and impossible to remove afterward. 2. Monetary tools reshape political power. Control over liquidity equals influence over governments, markets, and debt sustainability. 3. Dependency is the real transformation. When markets rely on intervention, autonomy fades quietly. Final warning: the real question isn't whether central banks cause crashes. The real question is this: if every crisis increases their influence, what happens after the next one? Will the tools expand again? Will intervention move even closer to direct economic management? History suggests the answer: crashes come and go. Power rarely shrinks. If this breakdown changed how you see financial crises, subscribe for deeper investigations into money, debt, and the hidden mechanics shaping our world. Because the next crash won't just test the markets. It'll test who controls the system when everything falls apart.